Good evening. Thank you, Master of Ceremonies. On behalf of my colleagues at Jefferies here tonight, the Jamaica Stock Exchange, and NCB Capital Market Limited, I pass on to all of you a heartfelt Happy New Year. The Most Honorable Andrew Holness, Prime Minister of Jamaica, Mr. Julian Mayer, Chairman of Jamaica Stock Exchange, Dr. Marlene Street Forrest, Managing Director of Jamaica Stock Exchange, and numerous guests and dignitaries and all other protocols fully acknowledged. Welcome to our conference this year. As we embark here at the beginning of 2024, finally at the endemic stage of a historic event we will hopefully not see again in our respective lifetimes, it brings me great solace that this conference will shine some rays of hope and excitement during these challenging times. Jefferies continues to remain a partner of this terrific JSE event, as well as remaining committed to the entire Caribbean region. It has always been a great honor over the past 18 years to be asked to give a few remarks at the opening ceremonies at this event. As a managing director of Jefferies, my mandate is to serve our clients with the absolute best we have to offer as a firm. So we pool our talent and resources to create the very best solution for our clients. In short, at Jefferies, we never rest on our laurels. The global markets are constantly evolving like I have not witnessed in the 40+ years that I've been in the investment business. But at Jefferies, we take pride in creating new opportunities for our clients of ways of doing business, whatever the odds. Our ethos, based on my nearly 10 years at Jefferies, is that the client always comes first by way of integrity, transparency, tenacity, and humility. At Jefferies, we are solution-oriented. Just a quick side note before I begin my remarks, and I know we're on a hard time for the Prime Minister, so I will hurry, that these are my comments and may or may not represent the comments of Jefferies LLC. I always have to say that for compliance reasons. Let me start off by commenting about the current situation in U.S. markets, the global landscape, as well as some thoughts about the Fed and their current historic tightening cycle. During my career, I have witnessed a handful of these aggressive tightening cycles. And I can tell you that when the U.S. Federal Reserve hikes 525 basis points in a 16-month time span, it will eventually put pressure on the U.S. as well as the global economies. But actually, this sort of tightening cycle is a more normalized phase that has been eerily absent from the days of quantitative easing emanating from the Great Recession all the way to COVID-19 pandemic that ushered in these historic waves of economic stimulus. True, during the past few years, I have never seen this hawkish of a Fed in my lengthy career. But in the same breath, the pandemic was something that nobody actually knew how bad this god-awful virus was going to be or how long it was going to last. Understandably, the global banks tossed in immediate, unprecedented waves of stimulus as a means to buffer the economic side effects of the pandemic. So here we are in a new year. We finally arrived at the endemic. So last year it was time to unwind the stimulus, which brings me full circle to my earlier comments about this past rapid tightening cycle that has put us on a more normalized global economic path that has been more prevalent throughout history. In other words, the days of zero rates are nothing but in the distant past. So after years of synthetic economic expansion, I view the current economic landscape as a much slower growth moment. But as seasoned investors, we must remember the recessions are normal phases of economic cycles, and they only tend to last between 24 and 26 months based on my experience, whereas expansions last far longer. Again, in normalized cycles, you must first go through the choppy waters of one in order to make your way towards some smoother waters towards the other. These smoother waters will eventually be evident once the Fed, as well as other central banks, begin to ease off the brakes of the respective tightening and begin to move towards the more desirable mode of accommodation. In the United States, it's my opinion that we remain in a recessionary cycle while interest rates remain elevated. As far as the Fed, it remains my ongoing belief that they are extremely comfortable with the 525 bips historical tightening that they've already orchestrated, comfortable that their mission has indeed been accomplished. Sure, they might continue some hawkish tone in order to convince everyone that they stand ready, if necessary, just to ensure the flames of inflation that were synthetically created are needed due to the pandemic have been completely extinguished. However, any sort of recession is not to be feared. These are natural parts of economic cycles that have been absent for too long. At Jefferies, we'll use all our resources to help clients navigate and invest smartly during these moments in time when many investors are not quite sure what to do next. I view a recession as a bridge towards an expansion, a bridge that can be traversed across successfully as a bridge in a roaring bull market. You see, recessions are not a medical diagnosis. They are just a natural occurrence that many of you out there have not faced before, given the fact that the average age of Wall Streeter is now about 30 years old. From my perspective, the US bond market has never sounded the alarms of a recession this long in my career. Given the length of the current yield inversion, it remains my opinion that the US will head towards some sort of contraction here in 2024. Once it arrives, the Fed can then accommodate and thus move things towards the next phase of a normalized cycle, that of a recovery and of an expansion. I know the markets have not been too much fun thus far in 2024, especially having gone through a pandemic, but this is a necessary stage given the gobs that were deployed to offset COVID-19. This is why I am a believer that fixed income markets will likely outperform the equity markets in the foreseeable future. Fixed income usually fares far better during recessionary periods in the beginning stages of a forthcoming expansion as well. In other words, the era of free money has indeed left the building. It is my opinion that in 24, this will be the year that realism replaces the 2023 year of complacency and momentum trading. You see, I believe this because it's been my experience that the Fed hike lags will soon kick in and kick in hard. And as I stated earlier in my comments, recoveries do not begin till the Fed has not only finished their tightening cycle, but months after they actually begin to shift towards accommodation mode. The good news is that I think the Fed is done with the respective hikes, and I also believe that we are many months away from the time that they will begin to cut rates. So the only put that I see is to put your focus on the silos of fixed income at this juncture. Remember, even though treasuries have been rather volatile of late, there is a reason the 10-year note is still trading above 4% handle, yet Fed funds remain above 5%. From my perspective, there is a value in fixed income after last year's debacle up to a few months before it ended in 23. But I can't say the same for the equity, which still trades at frothy multiples. Again, it's been my experience that in a normalized pre-recessionary cycle, the PE multiples should be far more muted than they are in today's market. The stock market rallies can be intense, they can be long-winded, but I argue that these rallies will not be sustainable during the earnings erosion phase that we are beginning to witness as we speak. During a recession, it's always best not to overthink things. It makes more sense to simply stick with defensive names or credits that have solid balance sheets and fiscal stewardship. I have found in my many years in doing this that in recessions, the trend is no longer your friend. I think here in 2024, the Fed hike lags, and then the Fed will pivot, will be the story. This is exactly why we are currently witnessing low yields when it comes to bonds, even when the Fed hasn't changed their conjecture. No matter what the Fed's conjecture may or may not be, the years of unadulterated stimulus are gone, and yet virtually everyone in the street is doing exactly what they did at the end of 1989, 2000, and 2007. And that's gazing in the rearview mirror instead of looking through the front window. The yield curve has now been inverted for 14 months, making it the longest period since 1979 through 1980 that precedes the nasty recession. It is beyond my comprehension that anyone would bet against that metric. Please keep in mind that I was in the business during much of those timeframes I just listed, and there has always been a distinct correlation between the depth and the duration of a yield inversion and how long and how deep the recession proves out to be. This is an enormously powerful signal and with far more compelling track record than the equity markets have. So what am I expecting for 2024? Not all peaches and cream, that much is for sure. The fact the stock market has very narrow breadth, meaning the so-called Magnificent Seven added with overbought sentiment, has me a bit concerned. As I mentioned, nothing goes up in a straight line in perpetuity. If you like stocks, be defensive. But if you like bonds, it's time to play offense. And you play offense before the Fed begins to cut. Recessions are notoriously difficult to predict, and nobody gets it right for the right reasons either. So during times such as what we're witnessing right now, I tend to keep it simple. The Fed is done, and the next move will be to ease, ergo buy bonds, and they should fare very, very well in 2024. And now on to some comments about emerging market debt and my favorite topic of Jamaica. After what we would all agree was a horrible year for emerging market debt in 2022, the year 2023 saw some positive retracement. The MB Global Diversified Benchmark rose 11.1% over the calendar year, benefiting from the underlying carry from higher but broadly stable U.S. Treasury yields and a tightening benchmark credit spread nearly 70 basis points. What were the key factors that explain the strong performance? They came from outside emerging markets as well as from inside. The key factor from the outside was a slowing pace of the Fed's tightening and the signals the Fed would pause and even begin cutting rates this year. That isn't just a sentiment indicator for emerging market debt. The higher U.S. rates are, the higher the refinancing costs for emerging market borrowers, and it's an unfortunate fact of life. Moreover, local rates in emerging market countries are also linked to U.S. rates. It is very difficult for the average emerging country to completely decouple its domestic monetary policy from Fed policy. So a pause in the Fed hikes with the possibility of cutting with a cutting cycle relieves tension in the macro policy for emerging countries. Factors more directly related to emerging markets also explain the strong performance last year. For example, the only one to default in emerging markets in 2023 was Ethiopia. Ghana, Zambia, Sri Lanka all made progress with their respective restructurings. So how does Jamaica fit into the narrative here? The Jamaica sovereign bond continued to perform well amid strong policy framework and a lack of new issuance. The Jamaica sub-index of the MB returned 13% compared with 11% of the overall benchmark. So again, let me put this into plain English. The fact that your government had the needed fiscal surplus and therefore did not have to seek new issuance in this high rate environment is once again attributed to your government's own fiscal savvy. PM, I'm rushing as quick as I can. I know you have to go. Okay, so I'll zip through this. Those of you who heard my remarks last year might recall I predicted rating upgrades into double B for Jamaica in 2023. I'm happy to say that it played out as far as my prediction. S&P, Moody's, as well as Fitch. So Jamaica's policy efforts are indeed paying off. A few weeks ago, even the World Bank commented on the positive rate of growth of Jamaica. Right now, Jamaica's credit is trading near or about the same level of many investment-grade sovereigns, and they are doing so for a reason. The reason is this country, from a fiscal standpoint, continues to do all the right things. I've been coming down to this great country for over 30 years now, and I have seen a small, struggling country morph into the crown jewel of the Caribbean. Congrats to all of you. Congrats to all of you, to your compatriots, and to your government on an incredible success story that I have personally witnessed from its initial stages. Needless to say, from the bottom of my heart, and I absolutely mean this, I am truly elated for your progress. On behalf of my colleagues at Jefferies, as well as the Jamaica Stock Exchange, I thank you for listening to me this evening, and I know that each and every one of you that is present this evening will enjoy the conference tomorrow and have a wonderful experience. Thank you very much, as always.